Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, absolutely.
So, I want you to imagine you're managing a company's sales team, right? Would you systematically fire your absolute best, highest performing salesperson just because they hit their quota and then, turn around and use their salary to give your worst, most unproductive employee a massive raise?
I mean, you would probably be out of a job pretty quickly if you did that.
Right, exactly. But here's the crazy part. If you have a brokerage account, recent analysis shows that you are likely doing exactly that with your own money.
It's just a phenomenal contradiction. I mean,
Yeah.
we are perfectly rational in so many areas of our lives.
Yeah,
But the moment we log into a brokerage platform, all of that logic just completely
that's
evaporates.
gone.
Right, it's just gone. And the data shows this affects everyone. It doesn't matter if you are managing, say, $500 on your phone or $5 million in a trust. The human brain is just wired to make the exact same error when evaluating a portfolio.
So our mission today for this deep dive is to really dig into the mechanics of that error. We are exploring the psychology of why we, hold on to our losing investments and sell our winning ones.
Which is so common.
It really is. And more importantly, we are going to lay out a framework for how you can rebalance your portfolio based on future potential rather than past emotions. Because let's face it, opening an investment app is it's a highly emotional experience.
Oh, absolutely.
You log in, and immediately the screen is dominating your attention with two highly manipulative colors, right? Bright green and bright red.
Yeah, and those colors, they are not an accident at all. The user interface of modern brokerages actually creates a physiological response.
Really, like a physical reaction.
Yeah, exactly. When you see green, you literally get a dopamine hit. And when you see red, you feel stress. According to the research we are looking at today, the way those colors make us feel drives some of the most destructive financial decisions everyday investors make.
Wow.
The data highlights this very specific pattern where investors mistakenly believe they must sell a profitable green stock just to free up cash to buy something new.
I have to admit, I have done this exact thing.
We all have.
Right. Like you see a new opportunity in the market, maybe a new tech company, and you really want to buy it. But your account says you have zero cash available.
Yep.
So you scan your list of holdings, you see a stock that is up 20%, glowing green, and your immediate thought is, perfect, I'll sell that, lock in the profit, and use the cash for this new idea.
Exactly. Meanwhile, you completely ignore the stock right next to it that is down 30% and just glaring red.
Right. It's like it doesn't even exist. Why do we do that?
Well, the psychology driving that choice is fascinating. Investors rush to sell the profitable asset to secure the gain because they want to guarantee that psychological win.
Oh, that makes sense.
But they refuse to touch the losing asset, the one down 30%, because of a deeply ingrained cognitive distortion. We tell ourselves, if I don't sell it, it's not a real loss, it's just a paper loss.
Wow, right.
And behavioral finance defines this phenomenon as the disposition effect.
The disposition effect. It's like the illusion of a realized loss. It's this mental gymnastics where we convince ourselves that the loss only becomes reality the physical second we hit the sell button.
Exactly. Until then, we just view it as a temporary setback.
Yeah.
Taking that a step further, it is loss aversion in its purest form. Our brains are just terrified of the finality of a loss. But we have to face the harsh economic reality here.
Right. The numbers don't lie.
They really don't.
Yeah.
The data illustrates this with a simple mathematical truth. Let's say you bought an asset for $1,000. 6 months pass, and the value drops to $700.
Okay.
Your app shows a red minus $300. The stark reality is your current wealth is $700. Holding on to that asset does not mean you are still holding $1,000 of value that is just, temporarily hiding.
That makes me think of an everyday analogy. It is exactly like keeping an expensive, incredibly ugly jacket in your closet.
Oh, that's a good one.
Right. Like you paid $300 for it, you wore it once, and you realized it's terrible, it doesn't fit, the color is awful, and it just sits there taking up space.
Yeah.
And every time you look at it, you feel guilty. But you won't donate it or throw it away because you think, well, if I get rid of it, I've wasted $300.
Yep, the sunk cost.
But the money is already gone. The jacket isn't $300 anymore. It is just a useless piece of fabric taking up valuable space in your closet.
That is a highly accurate way to visualize it.
Yeah.
The capital was spent. The current utility of the jacket is zero. regardless of the price tag on the original receipt.
Right.
In the stock market, clinging to that original purchase price is the primary reason everyday investors fail to adapt. The market is a forward-looking mechanism. It does not care what price you bought a stock at. The stock doesn't know you own it.
So if my purchase price is totally irrelevant to the market, what is actually moving the needle? Like, what makes that $700 stock go back up to 1,000 or drop down to 500?
The underlying mechanics of price movement, according to historical data, are driven strictly by forward-looking fundamentals.
Okay.
The market is constantly asking, what will this company earn tomorrow? We are looking at corporate earnings, right? Like, is the company's profit margin expanding or shrinking?
Right.
We're looking at the broader economic cycle and interest rates, which determine how expensive it is for that company to borrow money.
So it's about the environment the business operates in, not my personal entry point.
Exactly. We also have to factor in overarching government policies and macroeconomic shifts.
Like what kind of shifts?
For instance, whether we are looking at new trade tariffs, international supply chain restrictions, or corporate tax adjustments under the Trump administration.
Okay, yeah.
Those macro-level policy shifts directly alter the future earnings potential of a business. If a new policy makes it 20% more expensive for a company to import its raw materials, its future profits will drop, and the stock price will adjust downward to reflect that new reality.
Wow, so the market just adapts instantly.
It does. Your personal entry price from 6 months ago has absolute zero impact on those macroeconomic forces.
That reframes things completely. Relying on the original purchase price means you're making decisions based on your own emotional history, completely divorced from the actual economic reality of the business. But, holding onto that ugly jacket doesn't just take up emotional space. In the market, it actively damages your future returns. So if we systematically sell our winners to fund new ideas and refuse to sell our losers out of stubbornness...
Wait, let me rephrase that. If we refuse to sell our losers, what is the mechanical effect on a portfolio over a 5 or 10-year period?
Well, the mechanical effect is severe portfolio degradation. Let's return to the business manager analogy you mentioned earlier.
Okay.
When you consistently sell your profitable stocks and keep your losing ones, you're actively firing your top salespeople and promoting your worst.
Ouch.
Yeah. Profitable assets are usually strong for a very tangible reason. They have robust industry outlooks, they're expanding their market share, or they have exceptional management. Losing assets are generally weak because they're losing competitiveness, or maybe the product is obsolete, or consumer trends have just shifted away from them.
So by constantly trimming the green, you're effectively cutting out the companies that are actually doing well, the ones proving their business models work in the current economy.
Right. And by keeping the red, you are actively accumulating a collection of companies that are struggling to survive.
And over time, this habit leaves you with a portfolio entirely comprised of weak, underperforming assets that offer nothing but a hope of recovery.
Wow.
You are no longer investing based on strong financial fundamentals. You are holding a portfolio of hopes and prayers. You have systematically removed all the high-quality growth engines from your account.
Okay, I have to push back a little here to clarify a very common misconception.
Sure.
Because I watch financial news and analysts are constantly talking about taking profits off the table. You're not suggesting that an investor should never, ever sell a winning stock, right? I mean, there has to be a time to cash out the winners.
Oh, definitely. That is a crucial distinction. The data is absolutely not suggesting you hold a winner blindly forever.
Okay, good.
The key is the mechanism and the reasoning behind the sale. There is a massive structural difference between taking profits because an asset has genuinely outgrown its role in your strategy versus selling it just because you want to lock in a green number on your screen.
So how do you differentiate the two in practice?
Selling a winner is completely justified if that stock has grown so much that it creates a concentration risk.
Like it's too big a piece of the pie.
Exactly. For example, if a tech stock had an incredible run and now makes up 40% of your entire net worth, you trim it to manage your risk exposure.
That makes sense.
You also sell if the company's valuation has become historically absurd compared to its actual earnings. Good rebalancing completely ignores the color of the return on your screen. It focuses entirely on future risk and the role that asset plays.
Ah, I get it. So you trim the tree when the branches are blocking the sun from the rest of the garden, not just because it gave you a lot of apples this year.
That's a perfect way to put it.
But let's look at the other side of the equation. We know holding on to weak assets degrades the portfolio, but there is also the issue of what that trapped money is missing out on, right?
Yes, and this brings us to a critical economic concept, opportunity cost, which is often referred to in investing as dead money.
Dead money.
Yeah. Waiting to break even is one of the most expensive traps an investor can fall into. Let's say you are holding a stock down 30%. You tell yourself the classic lie, I will just wait until it gets back to my original purchase price, and then I'll sell it so I don't take a loss.
Oh, we have all rationalized it exactly like that.
But what if it takes 3 years for that struggling company to slowly claw its way back to your original price? During those 3 years, your capital was essentially dead. It did no work for you.
Wow.
In that exact same time frame, you could have moved that money into a thriving sector that compounded at 10 or 15% a year. You didn't just avoid a loss by holding on. You actively forfeited a massive compounding gain.
It goes right back to the sports analogy. Waiting to break even is like a coach refusing to put their star player on the field until the worst player on the bench finally manages to score a point.
Yep.
You are benching your best money. You are letting your capital sit on the sidelines doing nothing, just to protect your ego so you don't have to admit you drafted a bad player.
And according to the analysis, this dead money trap is uniquely disastrous right now because of the types of assets retail investors are buying today.
Oh, what do you mean? What are they buying?
Everyday investors are heavily involved in highly volatile, trend-driven assets. We are talking about thematic ETFs like artificial intelligence, electric vehicles, or robotics, and especially leveraged ETFs.
Let's talk about leveraged ETFs because those have absolutely exploded in popularity.
They really have.
You see these 3 times tech bull funds, and people treat them like a shortcut to wealth. Why is the waiting it out strategy so dangerous with leveraged products?
It comes down to the underlying mathematics of how those products are built. Yep. Leverage ETFs are designed strictly for daily trading, not for long-term holding.
Okay.
Their mathematical structure actually decays over time in a volatile, sideways market.
Wait, let's look at that math closely. What do you mean by decay? How does an investment structurally rot?
Let's walk through it. Imagine a standard index is priced at $100.
Okay.
On Monday, the index drops 10%, so it is now worth $90.
Right.
On Tuesday, the index goes up 11.1%. 11.1% of $90 is $10. So the index is back to $100.
Got it. It went down, it went up, and it is exactly flat.
Okay, so the standard index broke even. Now let's look at a 3 times leverage ETF tracking that same index.
Yeah.
You buy it at $100.
Right.
On Monday, the index drops 10%, so your leveraged ETF drops 30%. Your $100 is now $70.
Ouch.
On Tuesday, the index goes up 11.1%. Your leveraged ETF goes up 3 times that, which is 33.3%.
Okay, so I make it back.
No, because it's 33.3% of $70. That is an increase of about $23. Your ETF is now worth $93.
Wait, really? That is wild.
Yeah.
The underlying market went down and came right back to where it started. The market is at 0% return, but my leveraged ETF structurally locked in a 7% loss.
Precisely. That is volatility decay. The math works against you in choppy markets. So if you are holding a leveraged product that is currently in the red, and your strategy is, I'll just wait it out until the market recovers, you are fighting a losing mathematical battle.
Because the math is constantly eating away at it.
Exactly. Even if the underlying market eventually recovers to your initial entry point, your leverage ETF will still be sitting at a massive loss. You are bleeding out while thinking you're just resting.
That fundamentally changes how you have to view holding these assets, which naturally leads to another major blind spot you highlighted in the research. The illusion of diversification.
Yes.
Because a lot of investors think they are protected from massive losses simply because they own a lot of different things.
And the data shows a deep misunderstanding of what diversification actually means. An investor might look at their account and see that they hold Apple and Microsoft directly.
Okay.
Then they own a semiconductor ETF. They also own a 3 times leveraged NASDAQ ETF, an artificial intelligence theme ETF, and some cloud infrastructure stocks.
I mean, to a beginner, that looks incredibly safe. They think, I own 50 different companies spread across 6 different ticker symbols and funds. I am totally diversified.
But if you look at the mechanics of what those funds actually hold, they are heavily overlapping. The top holdings in the semiconductor ETF, the AI ETF, and the NASDAQ ETF are all the exact same mega cap tech companies.
Oh, wow.
Mechanically, this investor is completely tied to a single technology cycle. They are highly vulnerable to the exact same macroeconomic risks.
So if one goes down, they all go down.
Exactly.
Yeah.
If inflation spikes and the Federal Reserve is forced to keep interest rates high, the cost of funding massive AI data centers becomes too expensive. When that happens, every single one of those assets, the single stocks, the ETFs, the leveraged funds, will crash simultaneously.
So they aren't diversified at all. They just bought 10 different tickets to the exact same roller coaster.
Yes.
And if you combine that with the disposition effect we talked about earlier, where they sell their green stocks and keep their red ones, it gets even worse, right?
Much worse. Imagine they owned one defensive healthcare ETF and it went up 5%. They sell it to lock in the green.
Because they want the dopamine hit.
Right. Meanwhile, all their tech and AI funds are down 20%, so they refuse to sell them. By doing that, they just sold their only true diversification and accidentally concentrated their portfolio even further into a single, highly vulnerable tech sector.
Listener, I want you to mentally audit your own accounts right now. Is your so-called diversified portfolio actually just 10 different versions of the exact same underlying risk? Because if it is, we need to talk about how to fix it.
Definitely.
We have diagnosed the psychological traps, the math of dead money, and the fake diversification. How do we practically rebalance without letting our emotions ruin it?
The transition from an emotional investor to a strategic one begins with a specific mental framework we can call the golden question.
The golden question. I like that.
The next time you look at a losing position in your portfolio, you need to ask yourself this. If my entire portfolio was sitting in cash right now and I was building my investments from scratch today, what percentage of this specific asset would I buy at its current market price?
I love that. It forces you to completely remove the past from the equation. You are pretending you have zero emotional attachment to the stock. Would I buy this exact company right now with fresh money?
And if the honest answer is none, then you must reduce it or sell it entirely, regardless of whether you are down 30%.
Just rip the Band-Aid off.
Exactly. Your capital is a tool, and it is currently sitting in a broken machine. This philosophy leads us to the strategic rules of rebalancing. And the first step is about setting a standard for what actually gets to stay in your portfolio.
Right, so if I accept my jacket is ugly and I throw it away, what am I looking for in the new jacket? What earns a spot in my account?
You only keep assets that have clear, forward-looking reasons for capital appreciation. You hold a stock not because it is currently green, but because its future mechanics are sound.
Like what?
It has expanding profit margins, it generates strong free cash flow, it pays consistent dividends, or it provides genuine defensive power against inflation. You make the asset justify its presence based on tomorrow's economy, not yesterday's purchase price.
Make them earn their spot on the roster every single day. But what about the companies that are struggling? I know we said to sell them, but what if I really believe the industry might turn around in like 5 years?
You have to brutally assess weakening prospects. If a company is actively losing market share or its core product is becoming obsolete, you must cut the cord.
Okay.
You accept the reality of the current valuation, you take the loss, and you move the remaining capital to a better opportunity. Holding on to a dying company for 5 years hoping for a miracle is the definition of dead money.
Okay, so I've cleared out the dead weight. But how do I avoid falling back into the trap of fake diversification? How do I make sure I'm not just buying a different ticker symbol with the exact same vulnerabilities?
You have to actively eliminate overlapping exposure. This requires really looking under the hood of your fence.
Right.
Ensure your capital is actually spread across different risk factors. You want different sectors of the economy, different geographical regions, and assets that react differently to interest rate changes. If you own 4 different AI-focused ETFs, you need to consolidate them so a single supply chain issue doesn't wipe out half your net worth.
That leads me to how people pick new stocks. A lot of people, when they free up cash, just look for whatever went up the most last week. They chase the hot new thing.
Which is incredibly dangerous. You should only buy new assets if they genuinely offer better risk-adjusted returns and true diversification.
Yeah.
Don't chase a stock just because it was mentioned on the news or had a 30% run-up. You buy an asset because it serves a specific mathematical purpose in balancing the overall risk of your portfolio.
I can hear a lot of listeners thinking right now, well, this sounds great, but doesn't selling and buying constantly cost me a fortune in taxes and fees? How does that factor into the strategy?
Oh, it's a vital component. Good rebalances is absolutely not about hyperactive day trading.
Good to know.
If you trade constantly, the friction costs, bid-ask spreads, transaction fees, and especially short-term capital gains taxes will actively erode your wealth.
Right, because taxes take a massive bite.
Exactly. Short-term capital gains are taxed at your ordinary income rate, which can take a huge bite out of your compounding power. Strategic rebalancing is about deliberate periodic improvements to your capital allocation. You review and adjust quarterly or annually, making sure the overall ship is still heading in the right direction.
Hearing the mechanics laid out like this, it actually brings a profound sense of relief.
How so?
Well, I think beginners feel this immense pressure to be right about every single stock pick they ever make. The red numbers feel like a personal failure. But realizing a loss isn't admitting defeat as a human being. It's just recognizing that a dollar bill is currently in a bad job, firing it, and moving it to a better
I
job.
love that.
You will feel physically uncomfortable hitting the sell button on a stock that is down 30%, but mathematically, it is the only way to grow.
That is the perfect psychological reframe. The goal of investing is not to turn every individual red line in your app into a green line. That is a video game mentality.
Yeah, exactly.
The actual goal is to improve the overall risk-adjusted return of your total wealth over a lifetime. A skilled investor fixes bad choices quickly and lets the good choices compound.
So to summarize our deep dive today, investing is not a game of recovering past money. The market doesn't know what you paid, and it doesn't care.
It really doesn't.
Investing is the continuous, logical reallocation of your current capital into the best future opportunities based on corporate earnings and macroeconomic realities. Start firing your top salespeople to protect your worst performers. Stop benching your star players while waiting for the worst players to finally show up. And beware of the math behind leverage decay and fake diversification.
Absolutely. And if I can leave you with a final provocative thought to mull over.
Please do.
The user interface of our brokerage apps often works directly against our own psychology. So imagine a new kind of feature. The next time you log into your account, try to visualize what your decisions would be if the platform completely hid your original purchase price and completely hid those bright red and green percentages.
Oh, wow.
If you only saw the current dollar value, the position, and the ticker symbol, well, what would you sell today?
That changes everything. A completely blind portfolio audit. I love
Yeah.
that. Well, that is all the time we have for today's deep dive. Don't forget to subscribe and hit that like button.